Hello, I'm Martin Fahy, CEO of ASFA, and I'm joined today by Lucy Thomas, who is the Global Head of Sustainable Investment at UBS Asset Management. Lucy, welcome and thank you for joining us.
Thank you, pleasure to be here. Really nice to be back in Sydney.
So, long career. You've obviously with T Corp, looking after investor stewardship. Before that with Willis Towers Watson and Morgan Stanley globally. Clearly, as UBS Asset Management's Head of Sustainable Investment, you get to see quite a lot of what's happening globally. What are the key themes that you're seeing at the moment, and what insights can you give us on those?
Sure, and what a year it's been for sustainability. I mean, the run up to this year with incredible momentum, incredible flows into sustainable investing assets across the world globally, particularly in Europe, but we also have seen it in APAC and obviously Australia, very strong in that regard as well. Some of the themes that have dominated this year are really rolling up to give sustainability or ESG a bit of an identity crisis with what it is and what it represents. So we're seeing a politicization, a polarization of views about what it is, and also many other concerns that are on investors' minds, like geopolitical risk, like inflation, like rising rates, like energy security. That means sustainability is at times put into question about what it means right now, but also maybe put down the list a little bit of the urgent versus the important. So it continues to be important for investors, but there are other particularly urgent issues on their mind. The other themes we're seeing is that climate continues to dominate. Mm-hmm. We're swamped by regulation in many parts of the world in sustainable finance. And impact investing continues to rise, with engagement standing out as the winner in how we do impact investing.
We might just maybe unpack some of those. You've talked about obviously climate and some of the more urgent energy systems transition issues that we were engaging with have tended to be sidelined by geopolitical. What are you seeing in the climate space? Have we lost control of that agenda, or can we get it back front and centre?
Well, climate continues to dominate, and when it comes to energy security, certainly what we're seeing is that the energy security debate is another reason and driver for the transition, because it's not just an environmental driver, but there's also a need to diversify energy sources globally, and that's playing out very clearly this year, Martin. The other things we're seeing within climate, I would say, is a very strong emphasis on demonstrating progress on net zero commitments. Not just raising commitments, but actually showing evidence and progress on implementing net zero across portfolios for investors. And the third theme that I think we're seeing within climate that's really exciting is around extending from not just climate risk management into the opportunity side of things. And in the opportunity space, green infrastructure, we're doing something in energy storage, which is particularly exciting. We've done a private markets green plan with a sovereign wealth fund recently, where it will be invested in both green infrastructure, energy storage, and a number of other different areas. I was at the One Planet Summit in Abu Dhabi, a climate summit a few weeks ago, and there was huge emphasis, many CIOs and CEOs from sovereign wealth funds, and huge emphasis on how do we get capital into emerging markets, because we know that that's where we need much of the renewable infrastructure that we need for the transition. And is there a role that the MDBs can play in freeing up that capital flow and acting as some sort of agent that can reduce the risk for institutional investors like Australian super funds, etc., to invest in these what are quite interesting projects.
Impact investing has tended to be rather a niche, relatively small scale activity, often around social affordable housing or philanthropic bonds, sometimes in that sector. Are we going to see a mainstreaming of impact investing, do you think? And where does it fit within the sustainability jigsaw?
Yeah, I think we are going to see mainstreaming of impact investing. I think ESG integration, as we know it, will become systemized, and those who have the data and the capabilities in data to weave that into how they do portfolio construction will continue to get stronger and smarter at doing that. We have a team we call QED, Quantitative Evidence and Data Science team, incredible bunch of data-focused using machine learning, etc., combining data sources to get smarter signals, smarter scores on how we do ESG. And that gives us space and time to think about impact in a different way. So for impact, we, like many in the industry, we focus on intentionality, additionality, and measurability alongside financial returns. When we look at impact in particular, we're breaking it down into the company impact, but also the investor impact. So what products or services is the company producing that are impactful, and we can measure that. But also then, what are you doing as an investor, and what's your contribution as an investor? And that's the additionality piece that's really critical. And so this is where engagement, again, plays a huge role to show and demonstrate that investor contribution to impact investing. We've done a lot of work with Harvard on developing impact methodologies, and we run portfolios using those methodologies. But we're also extending what we do in engagement to really strengthen that measurement and those outcomes.
We can't really talk about engagement without talking about member engagement and superannuation fund members. In terms of sustainable investment, but specifically around impact investing, what do you think are the key lessons that we can take to the Australian member engagement and superannuation funds around those topics?
Yeah, so globally, Martin, I'm seeing a much better recognition of the role and the value engagement can play for portfolios and for portfolio managers and investment managers. And hats off to the Australian market. Australia gets engagement and has for quite a while and does it really, really well. Where we are seeing engagement change is shifting into that more impactful side of things. So at UBS, for us, two important things are evidence-based engagement and outcomes measurement. So when I say evidence-based engagement, I mean doing our homework. So an example of that would be when we engage with companies on the transition. For example, we're focused on those hard-to-abate sectors, cement, aluminium, steel, but we need them. We need them for the transition, highly carbon intensive. And the team have developed carbon cost abatement curves to understand what is the ideal time frame that we can deploy CapEx and change those business models to ward off future carbon costs. And as you can imagine, the earlier time frame tends to be the more desirable place to be, because you avoid those future costs. But also there's a potential green premium or market share for buying green steel or providing green steel. So we use that, we bring that to the table in our engagements, because we think that evidence-based research is really getting into a workshop style engagement with corporates, and we want to be that white hat type activist. I don't mean in the traditional sense of how people think about activism, but we think that's really important. And that allows us to then push for the second thing, which is measurable outcomes. So in those sectors, for example, we're looking for 7% decarbonisation per annum. And UBS has a strategy that will have an alpha target that sits alongside that decarbonisation target, and we look to achieve both at the same time. So that for us is what we think is impactful, and using engagement in an impactful way. So
clearly when you talk to your teams around the world, those targets, those 7%, 5 years' time, there's going to have been a significant reduction in the carbon intensity of the portfolio. What do you think the landscape will look like? We do have globally the storm clouds of potential global recession intermediating that, but how will it manifest itself tangibly when members of superannuation funds look out there in 5-6 years' time?
Yeah, this is a great question, and we've put a lot of thought into what does that future look like. What we think will play out will be a lot more volatility both in carbon profiles but also in markets, and that's what we're trying to prepare for. And we set these beautiful glide paths of 7% per annum, but reality is we think that's going to be a lot more lumpy. And I think it's important for us all to set those expectations with members or with our client base on what that volatility might look like, and use the appropriate measurements. So maybe measuring over 3 years, but reporting every year and providing that transparency. Using a dashboard, we at UBS, we use a dashboard of metrics to look at to look at progress, because if you use just an intensity metric, for example, and the market value of the portfolio falls, your carbon profile could shoot up. But if you're using a combination of metrics, you can show that actually you are making progress and not just relying. So not simplifying it too much into one metric, but using a dashboard to tell the whole story. And I think that's authentic, and I think that transparency will build trust with our members and client base as we experience potentially this volatility. We're squeezing a huge disruption of the world economy into a very short time period, and I think we can expect it to look bumpy, and we should try to stay smart on it.
Lucy Thomas, Head of Sustainable Investment at UBS Asset Management globally, thank you for joining us, and challenging but exciting times ahead, and we're looking forward to seeing the outcomes of it. Thank you again.
Thanks, Martin. Great to be here.